Who says you have to go out and buy a whole bunch of different stocks to start investing? You don't. You can just buy one stock, an ETF. Let's talk about it. Welcome to Piece of the Pie with Ty. I'm Ty, and I appreciate you guys coming to check me out. If you like any of the content in this video, please hit that like button. And if you think someone else could benefit from this content, please share the content and subscribe to the channel and come back and see me. My channel is about making sure everyone is aware of the different avenues to get a piece of the pie. And today, we're going to be talking about the best growth ETFs. Alright, ETFs are exchange traded funds, and exchange traded fund, or ETF, is a type of security that tracks an index, commodity, sector, or other assets which can be bought and sold on a stock exchange, the same as a regular stock. An ETF can be structured to price anything from the price of a commodity or a diverse collection of different securities. And ETFs can be structured for a specific strategy. That's why you have different sector ETFs too. But today we're going to be talking about overall market ETFs. Everyone knows the most popular ETF and index is the SPY, which is an ETF that covers the S&P 500 index, which is an index of the top 500 companies in the whole US. Over the last year, the SPY had a growth of 33.89%. and that is great growth. So we're talking about ETFs, and as I said at the beginning of this video, if you just solely invest your money into an ETF that covers a vast index of the whole market like the SPY, whatever you put in, if you only put into that one company, you would have had a nice growth of 33+%. So that's what I'm saying. You don't necessarily have to go out there and find a whole bunch of different companies. And I'm going to show you guys why these ETFs are all the hype when we get a little deeper to see what they're made up of. Another popular ETF is the Vanguard S&P ETF, ticker symbol VOO. Over the last year, they outperformed the SPY. They had a growth of 34.1%. Another popular ETF is iShares Core S&P 500 ETF, ticker symbol IVV. They also had nice growth of 33.98%, and the top dog that had the best growth out of all the popular ones is the PowerShares ETF, ticker symbol QQQ, and they had a nice growth over the last year of 37.33%, and they had the best growth out of all the four that I'm going to be going over. But just because they have the best growth doesn't mean they're the best pick. We're going to get into what makes these ETFs so popular and why they might be good investments. Let's go to the computer. Alright guys, so we're going to do this research on Dividend Watch. I use Dividend Watch. If you haven't checked it out, Dividend Watch is a great place to give you investment ideas, how to find the best companies that pay the best dividends. You can track your portfolio and you can track your dividends. I like Dividend Watch, and of course I'm going to use them because I pay for them. Alright. And if you want to join Dividend Watch, they are pretty cheap. They're $64 a year, and they also have a free membership. Check free membership out. But if you do want to sign up, you can use my promo code TY15 and get 15% off of this $64. Definitely check them out. Alright, so we're going to get into the basics of what makes these ETFs tick. Alright, so first we're going to search the SPY. Alright, and this is the SPY, and these are the top 9 holdings in the SPY. Alright, you have Apple, Microsoft, Amazon, Facebook, Google, Tesla, JP Morgan, and Johnson & Johnson. Those all sound like companies that you guys know, and they're decent companies. As you see, it's technology, technology based, that's Apple and Microsoft, they are in the tech sector. Amazon, that's internet retail. Facebook, communications. Google, that's communication. Tesla, that is auto manufacturing. And finance, JP Morgan. And healthcare is Johnson & Johnson. So you can see how they're spread out. Alright, that's the SPY. And what you guys are going to see is some similarity. Now we're on the iShares S&P 500 ETF, and again they follow the S&P 500, and they have basically the same makeup. Top 9 companies for iShares: Apple, Microsoft, Amazon, Facebook, Google, Tesla, Nvidia. They got Nvidia in here, which is a great company too. JP Morgan and Chase. JP Morgan, you're seeing the same things, right? So you know that these companies are great companies. And then let's look at VOO, and this is the Vanguard S&P 500 ETF. Top 10 holdings: Apple, Microsoft, Amazon, Facebook, Google, Berkshire Hathaway, Tesla, Nvidia, JP Morgan, and Johnson & Johnson. Same companies. You guys are seeing the same companies, and you can see the percentage they have in it. But then we get to the last one. As you know, the first 3, they all follow the S&P 500, which is the top 500 companies in the US. But then you go to ProShares, QQQ, and what they do is they follow the NASDAQ 100 index. That's the difference. So they only have about 100 companies in their ETF that they're investing into. So they're putting almost double in those companies. As you saw, the percentages were lower on the previous 3, but they're invested in the same companies: Apple, Microsoft, Amazon, Facebook, Tesla, Google, Nvidia, PayPal, Adobe, and what's this? Comcast. They all look the same. Their holdings are about the same, and these ETFs can also let you know if you are looking for companies for your own individual portfolio. These ETFs are big name, very popular, and they show you which companies are the best. These are valuable companies I'm going through, and that is common sense. It's common sense about all these companies that they are pretty mainstream and pretty good companies. And that's a key thing about investing too. Common sense. The common sense of things will get you far. You don't have to be so technical all the time. It's okay to have a little bit of technical analysis, but still, when you get an investment, the main thing you need to do is make it make sense. So you see all of these popular companies, and then you're like, all right, I just showed you 4 different ETFs, and you don't know which one to pick, right? You don't know which one to pick. So then we go to ETF.com and compare them. Alright, now I'm on ETF.com and I'm comparing the PowerShares versus the SPY. And it tells you who is the issuer: Invesco, State Street Global Advisors. And you can see the expense ratio. So PowerShares is a bit expensive. And you can see the assets under management. The SPY has a lot more assets, but partly is because it has 500 companies compared to the 100 index. Alright, so this PowerShares, as I said, follows the NASDAQ 100 index, and the SPY follows the S&P 500. Like I said, that's the biggest difference between these two. And then you go down to the expense ratio, and as you guys can see, they're so close. But the PowerShares have been beating them out as of right now. But sometimes, as you see right up in here, the SPY is above the PowerShares, and that's because the PowerShares are invested more heavy in those tech companies. All right, so when tech went down earlier this year, you can see that the PowerShares were below, but as you see, as of right now, the tech industry is recovering and it jumped back up to compete with the SPY. But yeah, so you look at the year return, as I said, that's 74.49% for PowerShares, and the SPY for the year is 34.08%. But both of these are dang near close, and either one of them wouldn't be that bad of an investment when you're investing into one ETF for the overall market. Like I said, 34% is great. The average stock only returns a 10% return a year. That's average. So if you're looking at the SPY and you getting 34, that's 3 times the average stock. Alright, because not all stocks jump up and have that great growth. Alright, and then you can see the holdings breakdown on ETF.com too. As I said, because it's 100 companies instead of 500, it's more heavily invested into some of those big name tech companies. So it's 63% in tech. So if you want to be conservative and not have everything in tech, power shares might not be for you. As you see, a SPY and the other ETFs, they're a little more spread out because they have 500 companies to invest into. All right, as you see, but both of them basically are about the same, except for the power shares isn't as heavily invested into the financial field like the SPY. But you can see all of this on ETF.com. You come down to the holdings, and as I said, you can see the main thing about the holdings are the amount invested. The 11% invested into Apple compared to the 6.25%. The almost 10% in Microsoft compared to the 5.74%, because it has to spread itself over a lot more companies, and it's invested into a lot of financials a little more than the tech over here. You look over here, the top holdings are mainly all tech. Adobe, Nvidia, Alphabet, Tesla. You might as well have said Tesla is a little bit techy, but it's automotive. Facebook, Alphabet, Amazon, a lot of those companies have tech involved. And it's the same thing over here, but the percentages are lower. Alright, so those are some of the main things to look out for. And definitely use ETF.com. I know some people are looking at the ETFs that we were talking about and thinking, oh my God, they're completely high. There's a lot of ETFs out there that mimic the SPY that are a little less than the SPY. But these are the 4 most popular ETFs, and check them out. Make sure you guys do your research and check them out. Alright, so that was a quick run through on the most popular 4 ETFs out there. As you guys were noticing, the prices of these ETFs may be a little high, but you can use ETF.com and go pick some of the lesser ETFs like SPY-G or TMFC. They are 2 ETFs that I hold myself, and they follow right along with those popular ETFs. But you might get more bang for your buck if you go with the actual big names, because those most of the time outperform the smaller ETFs. But definitely just use ETF.com, Dividend Watch, whatever you use, and do your research and pick the best ETF possible for you. So this is a way that you don't have to go out there and buy a whole bunch of different stocks if you don't want to. It's a lot to keep up with, and some people just don't want to deal with all of that. But if you want to put your place in somewhere and something like 37% a year sounds great to you, you can just invest all your funds into one ETF. And if you pick a nice ETF that's very diverse, like the overall market, like these popular 4, you would be all right. That's what they are designed for. They're designed to take away the stress and work from finding companies and things. But on the flip side of that, ETFs do pay expenses. Alright, so since they have expenses, the return on your money would be better if you went out and bought those individual companies yourself. And that's why so many people do it. But it's a lot of work and a lot of research to keep up with all of that. But you don't have to. You can just buy one ETF and ride with it. I myself have multiple accounts, and in one of my accounts, I only hold like 5 stocks. And that account does great by itself. I don't have to do any moving around of things. That account is basically on autopilot. I don't ever have to worry about that account. And I'll show you guys what I have in the account in another video, the 5 stocks I have in that account. If you like any of the information in this video, please hit that like button and subscribe to the channel if you haven't already. I got plenty more to talk about. Thanks.